Let's talk to Nicole Elliott. She is a private investor and technical analyst, according to my board, and I think she's going to cover some equity indices. Very good morning to you, young Nicole.
Morning, Nick.
Okay, let's kick off with 3 slides. The first one is the S&P Toronto Stock Exchange Index, and there's some ghastly big dark candles there. That's not good news, right?
Well, I tell you what, yesterday the Bank of Canada increased their key interest rate by 25 basis points to 101.75%. So it's still just lower than the Fed's one.
Yeah.
But its governor, Stephen Poloz, then added, the economy is running at capacity and it is no longer in need of stimulus.
Okay.
I thought, hello, this sounds familiar. It sounds rather like Mr. Powell at the Fed, doesn't it? And all of his little merry men and women, which is, you know, everything's hunky-dory, everything's tickety-boo. We're putting up interest rates because that's the right thing to do. Well.
Or maybe not.
So now we'll look at the chart of the Toronto Index, and you can see that from the beginning of 2017, it's been panning out this broadening chart pattern, like a megaphone, yes, with 3 attempts moving higher, and we did hit a record high earlier this year. At the beginning of this year. So, yes, but I mean, talk about marginal new highs. I mean, it really is rather pathetic. And then in the 3rd attempt higher, and at the record high, we had a complicated head and shoulders pattern with 2 alternative necklines. One slightly downward sloping, one upward sloping, and it depends on, you know, but you can see there it's a rounded top, and we gapped lower, we gapped below both those necklines quite clearly. And then whoosh, Bob's your uncle, off we go to the races, which is where we are now. So this tells me, 1, be careful what you wish for. 2, note that the 50 and 200-day moving average, which are just about to cross to bearish. They could, depending on where we close tomorrow, they might well cross. The key thing is both of them are pointing down already. So that would give you a death cross. Those horizontal red lines that you see there are previous record highs in 2014, the upper one, and 2008, the lower one. So basically, this index is back to where we were a decade ago.
Well,
great guns, eh?
Yeah,
great
well, that's not a great chart. Okay, so let's move on to the Nasdaq chart. We closed 4.5% lower last night, I believe. This actually doesn't look as bad as I thought it would look.
No, but the key here is that this is the engine of North American so-called outperformance in the indices this year.
Point.
This is the one that's been doing all the heavy lifting. And this one is nearly, while it's still just above where we started in January, and it is just about the only index that's still in positive territory, just and only just. It has come off quite a bit and is unlikely to keep on doing the heavy lifting. Moving averages are nowhere near crossing to positive, and we've retraced a Fibonacci nearly 61% of this year's rally, because the low was in February, Now, we're still within that accelerated uptrend channel that we started in 2016. But notice how much higher that channel is than the channel from the 2011 low. Look at the rake of the more established, steadier uptrend to the recent uptrend. You can see this is very much on the expensive scale of things, no doubt about it.
But again, what's interesting to me on that chart is you've got basically at the market top, you're looking for inconsistency, and suddenly we've got these big, long, dark candles again, you know, showing the sellers coming in force.
I often describe this kind of rally as like a funicular railway, you know, with the cogs. And when one cog goes, boy, does it slip hard. Yeah, you inch your way up, one cog at a time, and then poof, you know. And this is the sort of thing you would expect of a rally of this nature.
Understood. Okay, let's wrap up with the final slide. We've got the DAX. And again, we've got a weekly chart. Now, anyone looking at that and sort of learning technical analysis would see a topping formation of some magnitude, And that you just wouldn't be long this market, would you, from a technical perspective?
Absolutely. I mean, this I'm going to sort of cast in aspic and put into a textbook, because I couldn't get a better head and shoulders top,
Yep.
major top if I tried, or if I'd even
anyone
drawn
watching-
it freehand.
Anyone watching this for the first time in terms of technicals, a head and shoulders by default is a very bearish pattern.
That's right. Not only is the top a record high,
Yep.
it is a double top which forms the head,
Yep.
and you've got two shoulders
Yep.
which are roughly of equal height and equal width. I mean, it's perfectly symmetrical. The neckline I drew in there, it's labelled for you. Moving averages, 50 and 200-day moving averages already had a death cross in
Yep.
July, so they're, you know, the acceleration has started. We've broken a trend line that has been holding up the prices for quite some time. We've given up 50% of the rally since the beginning of 2016. And in fact, the rally hasn't been 3 years long. It was a 2-year rally. And then since the beginning of this year, we've been sort of not going higher. And now we've turned down, okay, down seriously in the month of October, again gapping lower, okay, not gapping through the neckline, but gapping lower when the two big candles are nasty. Well, it's in fact this is the third consecutive week of fairly large weekly moves. I think the chances this week of closing, settling below that trend line and below the 50% mark are high.
Yep.
The obviously next stop will be the Fibonacci 61% retracement, and then the height of the head, which would get you down to 10,300.
So 10,300 is the
Below the Fibonacci,
that's the end game
Well, that's-
number.
well, no,
Or
no.
that's the minimum target, isn't it? The textbooks would say.
Well, it's sort of a realistic target for the potential first leg of a bear market.
Okay.
The first leg of a bear market.
Yep.
If we are to get a bear market, it could end up that we're not going any further, that the correction is over, and that somehow or other, with a bit of help from Nasdaq and co, getting back into channel support, the things will go. But I personally am very, I don't see Germany outperforming at all. I mean, let's face it, it's a one-trick pony, which for years has peddled an internal combustion engine as a luxury goods product. I mean, it's just not happening. An educated person cannot possibly buy a Chelsea tractor anymore. It's just not worth
the way of the world.
No, not worth doing.
Okay, well, we're all off to sell the DAX, I reckon. Nicole, on that note, thank you very much indeed.